Banks have been raising their dividends following the latest results of the Fed's stress test that we told you about yesterday, and that sent many bank stocks higher today. And we took notice of some of the dividend yields that these banks are paying. JP Chase, for example, is now above 3%. Many others are around 2.5%, which is more than the average yield of an S&P 500 stock. So we're wondering, will this make this sector, which has been floundering, attractive again? Joining us tonight is Ed Groshans. He's a financial services analyst at Height Analytics. Good to see you again. Welcome back.
Thank you.
What do you think? I mean, clearly people have had high expectations for bank stocks as the Fed was raising rates, but now they halted. Now there's talk of Fed rate cuts. What do you think the banks are going to do at this point?
I think we're kind of in a stable spot. If anything, I'd be slightly optimistic. You know, loan growth just has been in the low single digits. I think that's really going to be the driver of any value growth. And we haven't seen that yet. We've had tax cuts. We've had a strong economy. We've had recapitalization of funds overseas come into the U.S. economy, and it hasn't translated into loan growth. So we did have rising rates, but it was on the same assets, not new assets. So I think, you know, higher dividends will certainly add some value to it, but I think the strong economy is going to have to produce for the banking sector. And at this point, I like the fee income banks, the banks that have capital markets exposure, the banks that have international exposure, as opposed to just our true regional lending banks.
Right. I mean, those fees are what have made up the difference for those banks that are unable to make any money on the traditional way of borrowing and lending. So who do you like best in this group? Do you just pick from the group that has the highest yields, or what do you do here?
Only picking from the highest yield if I'm a yield investor. I think here I want capital appreciation, so I'm going to focus on JP Morgan, Morgan Stanley, and Goldman Sachs. I think there's a lot of market activity out there. I think we're going to see capital markets, both in investment and trading, pick up, and those are the firms that are going to benefit from it the most.
What about those regionals, though? Sometimes they can have a higher dividend yield.
They have a much higher dividend yield. Many of them are approaching 4%.
Right.
But at the end of the day, you know, the discussion over the past few quarters was deposit betas, i.e. how much it's costing for them to attract deposits, and that was going up. I don't think that's going away, even though yields are coming down. So I think they're going to experience margin pressure, and if they don't have loan growth to offset it, you get a nice dividend, but where's my capital appreciation to come along with that?
Indeed. Ed Groshans with Height Analytics. Good to see you again. Thanks for joining us tonight.
Yep. Thank you, Bill. Have a good day.